Hello, everybody. Welcome, welcome, welcome. We are so happy to have Lavon Idolet here. I want to call her Yvonne the Idol because she's just a smart woman, and she's a lot of fun. She has a great smile and a fantastic sense of humor. When, as an attorney, one of her areas is you got to have a good sense of humor. And today, Lavon is going to talk about securities exempt raises, which applies a lot to all of us, depending on if we're raising capital or if we're going to go into a particular opportunity. So thank you, Lavon, for being here, and take it away.
Thank you guys so much for having me. A little bit about me. I'm Lavon Idolet. I happen to have been an Olympian in my former years. I ran track professionally for 10 years, and I went to the 2012 Olympics. But I consider myself to be one of those people who's like a nerd who happens to be fast. So I'm a glutton for punishment. I went to law school while also training for the Olympics. And from there, I began a career around helping professional athletes get into passive investment opportunities and alternatives. And it led me down the path of doing securities law. So now I set up private equity raises, syndications, funds, and that sort of thing. And today I'm going to talk to you guys about SEC exempt raises, which basically means you get to avoid a lot of registration fees and things that the SEC has for public companies. And the laws were created to allow smaller companies and smaller managers to have a sort of cost-effective way to raise capital. And the most popular of which most people have heard of now would be crowdfunding. So we're going to go over quite a few types. I'm going to share my screen now because I'm going to share this really nice chart that the SEC has up, even though they have not updated it. And the amount that you can raise for crowdfunding has gone up significantly from $1 million every 12 months to $5 million every 12 months. So here we are. And let's see if I can make this the entire screen, and then that'll be nice. I'm gonna act like I know how to use this stuff really well. Let's go with the 150. That sounds good. All right. So my favorite exemption of this entire bunch would fall under this Regulation D lane. The reason I like Regulation D specifically was the changes that came about in 2012 with the Jump Starts the Jobs Act. And the reason I like it is because 506C allows for general solicitation. So if you know, right now, the biggest and easiest thing about the moment is you can reach a lot of people with social media, with regular media, billboards, that sort of thing. So I know you've most likely seen a Grant Cardone ad or something. He raises using general solicitation. And for that reason, he's been able to raise close to $1 billion in the last 5 years. Different raise types, but 506C particularly does not have a limit on the amount of money that you can raise. So it's very popular. The only sort of downfall that most people find is that although you do have to have only accredited investors, you actually have to do an additional step, which is verifying that they are accredited investors. A lot of the other types of raises, they'll just ask you, are you an accredited investor? If they check yes, you just move on. This particular type, you do have to do an additional step, which is you take either a letter from their CPA, a tax return, or something like that, that will show that they either have made $200,000 over the last 2 years, or they have $1 million in net worth. Typically, the easiest way to do that is to use a third-party service. It typically costs like $20 to $40, and it makes it easier for you to do it and takes the onus off of you sort of like badgering a person who may be someone you know casually, and you don't want to be like, do you really make this much money, or do you really have this many assets? And so the other popular Regulation D raise is 506B, and the reason why is because it allows up to 35 sophisticated non-accredited investors. And, you know, most people know people who have some capital, and they may not necessarily fall into the category of making $200,000 a year or having $1 million in assets, but they may have, you know, $50,000 or $100,000 to invest because they saved it in a 401k, or they have it in a self-directed IRA, or they have just cash. People save a lot of money regardless of how much income they're earning annually. And this is the Regulation D way of allowing those people to participate. And the only filing requirement for anything under Regulation D is a Form D, which is a few pages, and it just asks for general information about who the person is that's raising capital, what you're intending to use the capital for, the structure, how long you intend to keep it, and how much you raised. It is just a filing, so it's not an approval needed. That's why I prefer this over some of the other methods, because you want to have full control over what you do versus having someone tell you you can do it or not. The other important thing about a Regulation D raise is that there is a restriction on resale. So these are illiquid assets that a person will be buying. A small percentage of the building that you're raising for, or that business that you're acquiring. So for 12 months minimum, the person who is your investor will not be able to resell it to someone else or transfer. And a lot of times you would probably prefer to restrict it beyond that, where you'd have to approve it or something, because one thing that I tell people about raising capital is it's sort of like being married. So you want to court and date the people so that you know what you're getting into. You want people to invest with you who believe in your strategy, who believe in what you're doing, and they're not going to call you every 2 weeks because they may or may not have cash flow issues and they want their money back, or whatever the case may be. So restriction on sale keeps it so that you have control over who your investors are. And these types of raises have preemption on state registration, which means that all you have to do is file a form in the states where you are based and where you have raised capital, and there is no application process or anything like that. Some states do have fees, but a good amount of them do not. So what I tell people is there are probably 6 states that have really high fees. Avoid investors from those places unless you absolutely need it. So New York is one of those places where the filing fees are quite significant just for taking capital from New Yorkers. So beware, especially for people who are located in Florida, because we tend to have people who actually live in other places. And so you end up with a bunch of like filings that you have to do because you met them in Florida, but they are really actually Delaware or Chicago residents or Canadians and whatnot. And so you need to make sure who you are, where your investors are actually located. So regulation crowdfunding also came out during the Jobs Act of 2012, and it initially allowed you to only raise $1 million a year. Now it's 5 million. And the only real requirement there is that you use an intermediary. So an intermediary is a platform that is a website typically, and you generate traffic to that website, and you have all of your documents and your marketing and what you intend to do on that website. And they sort of act like an escrow agent. If you do not raise that minimum amount that you put, they send the money back to the investors and you never receive it. The one thing that most people don't know about intermediary pass platforms is they're not evaluating your deals. So they can't say yes or no. They can just say, do you have all of the things that are required for you to be listed? And then they can give you their set of fees for the listing, which is typically a percentage of what you raise. There are so many platforms at this point. The most popular of which that I like is WeFunder. A lot of people also know about like a Kickstarter is actually not a crowdfunding website, but most people think it is, because you're not giving away equity on a Kickstarter campaign. You're giving away product typically, or some sort of like member benefit to get like raving fans. It's a good place to raise capital that doesn't give away equity though. Every single type of raise that I'm going to talk about tonight does have a bad actor disqualification. What that means is if you've ever had a felony or a misdemeanor for moral turpitude, which typically means things like fraud and embezzlement, that sort of thing, you will be precluded from ever being able to raise using any of these exemptions. And which is good, because, you know, it's sort of like a, once you do something like that, it's hard to be trusted again sort of deal. The most famous of which is, oh man, the guy from the Fire Festival is precluded from raising capital ever again. He's got a lifetime ban after doing his prison time for bringing all those people and lying and raising a lot of capital for a festival that didn't even have places for people to live. So the thing about crowdfunding, there are a few additional steps that you have to take for your investors, which is there is a maximum amount that people can invest with you, which is 10% of their annual income or $10,000. And so that typically the platform will do it for you for a fee, so that you won't have that, especially if you're raising, let's say, $5 million at a $5 minimum, which is what some people do. They get $5 from lots of people. That can become a tedious task. So having platforms that do that for you, especially if you have smaller minimums, is the better thing to do, because you don't want to end up not in compliance because you're taking more money from some person than they are legally allowed to invest annually. The only thing that you're going to have to file with the SEC for this is a Form C. It's a little more comprehensive actually than the Form D, but it's just asking those same sort of things, like what you intend to do with the capital, use of capital, how long you'll have it out, how many people do you anticipate you're raising from, and sort of like a short, concise business plan. And you do have to say, if you have been in business for 2 years, you do have to have audited financials, but it could be a new company. And so you would just have a no financials check mark in that form. That also has a 12-month resale limitation. It's pretty interesting because a lot of the platforms are now giving you the option to resell your shares in something that you bought on that platform after that 12 months. So creating that like community movement, sort of like a public stock, because there's not really much demand for a small piece of a small company. That's sort of the only way to create a market, and it's not had a lot of traction yet. But I think over time, as people begin to create raving fans that didn't get into the initial raise, it'll be easier for them to get in from a resale. And you do have to register in every state that you end up receiving capital from. Now, Reg A Plus is one of the most popularly talked about types of raises at the moment, because it allows, if you do a tier 1 or tier 2, there is an option where you can create a listing on a NASDAQ or secondary market. So you get a ticker symbol. So it's sort of like a mini IPO. And a lot of people like that idea. The only sort of downfall I see, there are 2 downfalls for me in a Reg A plus. One is they do have the ability to deny you from creating this type of raise. And the other is there is a lot of reporting required, because they're allowing you to become basically a public company quickly. You do have to file your financials and things like that on an annual basis. And they do not allow you to do like funds and things like that under that type of raise. You have to have identified the company that you intend to either purchase or merge with. You also have to identify the property if the reason you're raising is for like a commercial acquisition or maybe some other sort of real estate. As always, bad actors are disqualified. And there is also the 2-year audited financial requirement. But if it's a new company, you have audited financials that says nothing, 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 and it counts. What else? There is no limitation on resale, which is why you're getting sort of that instant IPO with this sort of raise creation. And then we have intra-state raises, which are pretty simple, except it just precludes you from raising money outside of your state. So wherever you're located and domiciled, if you raise money within the state, all the people are also citizens of that state. You get the benefit of having a very easy raise. It's just so hard now with the internet and the way that people socialize to ensure that you will have all your investors come from one state. So I typically don't suggest that people do that unless you're like, I already identified the 18 people who are going to invest with me, and they're all here in Florida, and they don't intend to leave this year, then you'd be safe.
Wow.
And so if you guys would like for me to share this with you, I would love to, especially because if you are also an investor, you want to know that the people that you're investing with are doing this properly, because the worst thing that can happen to a person who is raising capital or a person who has invested is that the SEC gets a complaint on you and they end up freezing the funds. And now not only is your money not in play earning a return, it's just sitting in limbo until they can investigate and maybe punish the issuer. But the worst thing about administrative law, it's definitely guilty until we've decided that you're not guilty. So you don't get any sort of like retribution from the fact that they may freeze your accounts because there was a complaint from an investor, and then 6 months has now passed and your money has not made any money. So it's very important to understand what you're getting into in advance and stay compliant and have everything in writing. Everything in writing is true. Everything not in writing is made up, and people will argue you down about it, even if it's your friends and family.
Thank you for that. I'm
Yes,
sure Dylan agrees with you 100% on everything in writing. I think that's his motto for all of this. So great. Thank you very, very, very much. This was really terrific.
Yes, Peggy, writing or video, whichever one works.
Or video, yes, that would be the same as writing, I would presume. Good.
Yep.
So do you have any comments or questions, Dylan? I
Nope,
know
no.
this is
Nope.
your arena.
Nope, I'm quiet.
Wow. Okay. Good. Anybody have any questions? Where's participants? Here we are. Okay. Well, I always have a question. And I know Dylan will be quiet on this because he already knows I go crazy about this. So I'll do that later after Cliff asks his questions.
So I apologize. I actually came in a few minutes late. You may have already covered this, but did you happen to describe requirements around establishing a relationship in the event you're raising capital for a 506B and the proper timing in doing that and what needs to be in place and how that's recorded?
Yes. So establishing a relationship is required in a 506B. You cannot just generally solicit to them. And so the best way to do that is you're going to record when you met them, how often you've spoken to them, and then you're going to also record in the future when you give them the offer, the date, so that you have this recording of the frequency, and because every state actually has a different standard on what they consider to be a pre-existing relationship. And so I tend to err on the side of like as conservative as possible. So go to the most conservative and then work backwards, which is you've had multiple conversations. They know who you are, you know who they are. And the reasoning for communicating previously was not just to be like, hey, I just needed to talk to you so that I can give you an offer in a couple of days. It's more like you're building a relationship. And during that time, you are supposed to be vetting their level of sophistication, specifically if you're going to take capital from a non-accredited investor.
Thank you for that. And if a private placement memorandum has already been issued, is there a safe and legal method of engaging an investor with a 506B so that I can still raise capital for an active opportunity?
Yes. So the safest way is to go out in your networking attempts is to just meet them casually, talk to them about what they're investing in general, get to know them, talk to them about the types of things that you would have in like a suitability questionnaire, and then ask them, would it be okay if you were to share opportunities with them in the future? And then you can send it. After all of those things, but it doesn't matter that you have already actively started raising for it when you meet them. Otherwise, they would have created a law that was like, if you don't have a network, therefore you cannot raise capital, which is not the spirit of the law.
Okay, so that actually is very good news, and that's great information, so I really appreciate that. I have more questions, but I'm going to yield for a minute, let other people.
Okay. I just, and Dylan and I have been through this a million times, I'm sure, but I just don't understand why it's so complicated, why people aren't allowed to invest their money. And so I have this question around I'm sorry, I can't remember which regulation it is, that they could only put 10% of their annual income. So let's just say we have met somebody who has about 300,000 or 400,000, maybe 500,000 in their IRA account, and they make, 100, 120,000 a year. They only could put $10,000 or $12,000 into a deal when they've got 300,000 that they want to invest in their IRA.
So,
yeah.
And IRA is the only. So, the reasoning for this is basically saying that your IRA is there for your future self to survive. And they sort of take the idea that private investing has human risk, market risk, and everything else that a person who, the threshold for earning is sort of arbitrary to me, because if you're, I know people who make way more money and spend way too much money and may be able to withstand a little bit less risk, but the reason has more to do with like your ability to sustain 100% loss. And so if you earned 100,000, which is, they're basing this on gross anyways, which means that whatever your take home is, that 10% could hurt your ability to actually pay your bills. And so they don't want people to, because human risk in this country specifically is a lot of people invest like betting. And so they would say, hey, here's this $300,000 because you told me that you could turn it into $1 million next year. And now you don't have that. And you also, so now you may, the fear being you may end up being a drain on the system that has to take care of the people in the future who don't have retirement. And so it has a lot more to do with like
keeping America broke.
America's
broke.
Risk management, but also the same. I do think that there should be some sort of, no, there are now other ways for you to invest more if you have like securities licenses and things like that, the complete understanding of what you're investing in. But I do think that 200,000 may be just like a random arbitrary number that made them feel good at some point a long time ago.
Well, a good capital raiser would never take all of their money and put it in one deal ever, because that's too risky. And anybody who is a capital raiser normally would work with the person and learn what it is they want in their life, their future. And the reason they have an IRA is to build it, not to have it sit there and do nothing. I don't know. I don't like.
I agree with you.
I don't understand their regulations, why they have so many of them, and why they don't understand when people want to get ahead in life, they need to be in something, not a security, which has zero security in it, but in something which I don't know why real estate is called alternative, because everybody pretty much lives in one, to have it become something for the rest of their lives so that they could take care of their children and their grandchildren and etc.
The biggest issue is that in a perfect world, there wouldn't be a Bernie Madoff. And so there are way more people who, if have the charisma to go out and take people's money with bad intention. And so I think there's like probably a little bit too much regulation around it, but there definitely has to be some, because the most charismatic bad players would be able to get the last of someone's money and never care if it's 10% or 100%. If you could pay your bills tomorrow, they would take it all.
That is unfortunate, isn't it? Yeah, go ahead, Cliff, unless somebody else has a question.
So you had mentioned earlier, Levon, about a suitability questionnaire.
Mm-hmm.
Working in life insurance, I'm familiar with a suitability questionnaire or in financial needs analysis. What would be a good suitability questionnaire out there? Is there one that's publicly posted where some people could actually get it so that they could learn, how to determine suitability with their clients? Or are there some basic key questions that you'd really like to make sure are on that suitability questionnaire to qualify that client?
So typically, suitability questionnaires are based on the raise type. And most people create their own questions, or their lawyers create their own questions. For me, the biggest one is like, what is your age? What are your expenses? How much do you currently have saved? How is it allocated? How much risk are you willing to take on for this return? And like, what else do we have as downside protection? So those are sort of like the questions that I ask just in general. And then like, how much money do you spend a year that we need to figure out how to get you above that amount so that you're not going into your principal after you retire, or even now, especially like, so my general client type retires at 30. So how can we get you to the point where you're not spending your principal by 30 is much harder than how can we get you to the point where you're not spending principal by 65. That's a completely different conversation. And so that's why age has to be a conversation, but it needs to be also, what's your income type? Where is it coming from? How are you currently earning it? Do you intend to work much longer? Do you intend to change careers? So those sorts of, you really need to know the people and their goals. And then, so all of the questions in the suitability questionnaire is about like, who are you? What are your goals? And how can we help you reach those goals? Versus like, if you just check yes, 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 we'll still take your money either way.
Thank you.
That's it. Anybody else have any other questions? I know SEC is a little foreign to many, many people. That almost anybody who is in real estate or alternative investments is what they're called, needs to be aware of SEC and what some of the rules and regulations are, because you do not want to be stepping in any holes and having somebody come, well, I'd say slap your hand, but as LaVon said, it's much worse than that. Giselle.
Yes, good afternoon, everybody. Thank you, LaVon, for today's presentation. I did have a question in regards to, you may have covered this. I also did enter late, but these SEC guidelines, they apply to like an accredited investor, or can you speak a little bit on that? Provide some clarity for me on that.
Yeah, so SEC guidelines actually apply to anything that's a security. And so how we define what a security is it's called a Howey test, and it's a 4-pronged test. And that is there a common enterprise, which means that there's one business. And then do you have an investor who expects to get a profit from the work of another, which means that you are not involved or a decision maker in any way. And so it could be for accredited investors, it could be for unaccredited, non-accredited investors. But if the person you're taking capital from will have no say in what you do with that capital and is not involved in the business, you are dealing in securities, and they all apply. And so a lot of people raise money without paperwork, and they probably won't get in trouble. But
yes,
they're not supposed to. And the reason that they end up getting in trouble at some point is because a person wanted their money back, and they'll report you to the SEC. And then they'll retroactively go back and look at everything you've done and create fines and things like that. Because I know a lot of people, especially in real estate, they raise capital from strangers, no paperwork, so anything that has more, especially more than one investor, I would say you should just save yourself the headache in the future and get paperwork in place. Even if it's someone in your family, because the worst thing that can happen to a family or friend relationship is you lose the capital, which can happen in any deal. And then it turns into some sort of a lawsuit that doesn't have proper paperwork.
okay, that's very clear. Thank you for answering my question. Because I am new to the capital raising arena, so of course, compliance is always key, and we like things to be black and white. We don't
Yes.
like no gray areas. So thank you for today's presentation.
You're
Appreciate it.
welcome.
Cliff, do you have another question? You had
I'll
your
come
hand-
back to it.
Oh, okay. Well, you could use it now. Thank you for sharing your child with us. And I like that you have her on the show so she can learn as she goes. And it's never too early. 5 months, you guys. We got a new SEC gal coming up.
Yes.
Yes, go ahead, Cliff.
Okay, so question. I had always, it was always my understanding, and please correct me on this if I am not on target with this. If you have people that are actually contributing their own funds into a common enterprise or an opportunity, as long as all of those individuals have an active role, it's technically not a security. But if someone decides to take a passive role in that, technically that now becomes a security. Is that correct?
Yes.
Okay.
So active roles, those people would be called general partners. And anybody who works in their business, they're general partners. It's the limited partners or the people who are inactive members who you'd be creating securities around. But the reason why I tell people that securities is the best thing that you can do as a person who's raising capital is because you know how hard it is to walk around and say, hey, I'm raising $1 million and have someone give you $1 million. It's much easier to say, I'm raising $1 million and I will take it in chunks of 25,000. And you can participate and you'll get a return on it. There are way more people with 25,000 than $1 million to invest with one opportunity.
Okay. All right. I just sent you the color for the walls. It's called softer.
You might want to mute David.
Oh, 1 second. Sorry.
Oh, here it is.
There we go. Thank you for that. So the reason why I asked that is I think that sometimes when people are just starting off in real estate, they may actually go to some of their friends and they have money and they say, yeah, I'll give you some money, but I don't want to do anything.
Yeah.
And then they take the money and then they go and they actually do something with that. And technically that becomes a security now, correct?
Mm-hmm.
Now, is there an easy process for someone to actually do a proper SEC filing for that security at that early stage in their real estate career? And if there is, what would that process look like?
So it depends what you're doing. So if it's specifically like, I'm going to have a partner who is passive and we're going to buy one house and we're going to renovate that house and we're going to rent that house out. The best way to do that would be as a JV, and you would give them the opportunity to have some say so in what you do. You're going to like consult them back and forth. One investor, one property, that's fine. And that JV would just look like any LLC. You'd both be members. You would say how you're going to split the profit. It'll be very clean that way. It's the creation of there's multiple properties or there's multiple investors where you want to then go and get a full offering set up, whether that's crowdfunding, whether that's a Regulation D raise, whether that's a Regulation A raise, and you just need three important things are a private placement memorandum, a subscription agreement, and an operating agreement, or a limited partnership agreement, depending on how you have it set up. But with those three things signed by each person who invests, you can compliantly do it. And once you have raised your first dollar, you would then create an account with the SEC, file your Form D, and it just puts them on notice. Then once you finish raising all the capital, you will go to every state that you've raised capital, where the person who is domiciled in that state you've raised capital from, and you file a form letting them know that you've taken money from someone in that state. That's it. Then you're good.
What type of, and the reason I ask that also is kind of lead into what type of price points would someone be looking at to actually do that so that they are in compliance? Because the reason I ask that is because that can impact someone that's just starting off in real estate
Mhm.
and make them think, well, if I try and skirt the system, I'm saving all this money. So, understanding what that range might be might make it easier for someone to understand that, build that into their capital raise properly.
Yes. Well, number one, not every single expense that you have in the business can be reimbursed by investors. So never look at it as an expense per se. That's like something that you're spending money on. Number one, a pinch of prevention is better than a pound of cure. So the expense of doing it right the first time will save you so many headaches and so much time, number one. But the range is huge because there is the ignorance factor. So it's sort of like getting a website built. If you know what to ask for, someone will probably only charge you a few $100s. If you don't, they may charge you thousands of dollars. It's sort of like that because lawyers understand that people don't actually know what they're getting. And so on the low end side, people have do-it-yourself services where they'll sell you templates and whatnot. That'll be a few $100s. You could do it yourself, which I would actually say if like budget is the most important thing for you, go find a template, fill it out, take it to an attorney to overview, and then it'll save you a lot of hours and cost. The other side of that is your range will be somewhere between probably 5,000 and 50,000, depending on how much you're raising and how complicated it'll be. So some people are like, I would like to, I'd like to raise $50 million from people all around the world, and I don't want them to have to pay taxes, and I also want a crypto coin attached to it. That's going to be much more complex and higher in fees than just a general, I'm raising even $50 million, but from all United States citizens, and they are all going to invest a minimum of $100,000. Like, that's so much easier, clean. You probably end up paying the very littlest for that. And, but the price is most likely going to be close to 10,000 for any kind of raise from an exempt standpoint. And then on the other side of that, crowdfunding, the paperwork is a little less expensive. So let's say $1,500 to $3,000. But the platform is taking anywhere between 1% and 5% of what you are raising. And then traditionally, if you're going after large investors, institutions, that sort of thing, and you're using broker dealers and RIAs and things like that to raise the capital for you, you also have to price that into your raise, because they're going to take sometimes as much as 7% of what they raise for you and 7% of the equity.
Oh,
And so this is why I tell people, using general solicitation will save you a lot of money. It may cost you a little bit to create a content strategy. It may cost you a little bit to run ads, but when you go directly to investors, they know you, they like you, they trust you. They're not going through JP Morgan Chase to reach you, and you don't have to pay all of those fees and have them also as partners for bringing you their investors.
So you're working with personal relationships, and that's really, that's a good place to be.
thank you.
Okay. Yeah, that's fantastic. Thank you so much.
You're welcome.
So
Dylan,
it sounds like, well, real quick, just to recap, it sounds like if you have just one or two people that are working together, an LLC, working together. But if you go beyond that and you actually start bringing capital in passively, then you really should have a regular filing. Okay, very good. Thank you.
You're
Great.
welcome.
Dylan,
Just in addition to the Howey test, add in your risk capital test. Its case law is Silver Hills Country Club versus Sobeski. It's out of California, 1959.
And what is the Howey test?
The Howey test was the one that she had described as to determine whether it's a security or not. The risk capital, the same thing. It's just a different version utilized in different jurisdictions. It's a minority case ruling, but it is used in certain jurisdictions in certain states.
Thank you. That's great. Does anyone have any other questions? I know it's a unusual subject for us to have, but some of you are capital raisers and some of you are investors and some of you want to understand, which I suggest all of you understand before you invest with anyone, what kind of investment you are in and what are the protections put in place for you. Like that. So, yes, Dylan. Or do you just still have your hand up? He doesn't have his hand up anymore, so I guess he didn't have any other questions. David.
Hi, Peggy. Sorry about that. It's always when you're muted and not knowing that that's the case. Yeah, I have a question in reference to, we always hear about the generalities of this, but any proof, any case studies have come out with any details of what people have done and you know, what problems may have occurred in the past and so forth. I'm sorry, I just got on, so I missed part of it or most of it. So
case studies about what has happened to what do you mean? Give like something negative that has happened to someone, or
yeah, of course, yeah.
Okay.
What has come down from the court standpoint that somebody's been you know, ruled on their what they've done and some problems and things so forth. Yeah.
So generally, for the most part, what I see is people get in trouble for having complete lies in their offering statements. So it'll either be like, hey, we're raising capital for commercial real estate. We have all this money under management already. We have all of this experience already. And the truth is that they have no money under management and they have no experience. And so and then they end up getting some sort of a complaint, and then the SEC does an investigation and it ends up, they get fined and they get, at worst, they'll end up with some sort of a actual criminal investigation. And that actually happens quite often, especially with very large raises, because it's really hard for you to start at zero and then raise $100 million without either having a lot of experience or telling lies. So a lot of the people who did that told lies and they end up getting caught eventually. And like I was saying earlier, the worst thing that happens is that people, that even if you're doing the right thing and you didn't lie per se in your PPM, if you get a complaint to the SEC, what ends up happening is they do an investigation while freezing your assets first and let you figure it out later. And so it's very important that you're staying above board while raising capital. You're always talking, explaining things, making sure that the people who are investing with you intend to invest with you, that they're not going to have buyer's remorse in 48 hours, and that they're not investing their last, because when people get into distress, they will find a reason to complain about anything that you're doing, especially if you're doing something that doesn't have regular distributions. And so the biggest ones that I've seen in my career has been in development, because development is very risky. It does promise great returns, but it has no distributions throughout the life typically of the raise and the holding of the capital. And so it could be 5 years, 10 years before you see any return. And when things happen where the market's down and your other things and your business is going bad and you're like, I gave that guy $1 million and I haven't gotten an email from him in 6 months, that's when you start seeing the complaints and things come in. So the biggest thing I tell people is investor relations is huge. You have to communicate, and you have to communicate whether it's bad or good. People are understanding as long as you communicate. No one expects you to always win. No, but don't wait until you've lost to send that email. You need to say, hey, this is going on. There may be we haven't gotten approvals yet. We haven't got the entitlement done yet. And this is what's going on. It may take another 6 months. Just having the conversation versus letting years go by. And then you're like, well, sorry. And we spent a lot of the money because plans cost money. Using attorneys to go back and forth for land use costs money. The running of the operation costs money. So now your principal is down and we're sorry. And for most people, especially people who did not have the flexibility to lose principal, they're going to be in a very bad position, and they're going to feel like maybe you took advantage of them, and they're going to find a way, and they're going to take your PPM to a lawyer, and they're going to say, is there a way that I can get my full principal back from this person by suing them?
I have another quick follow-up question, and I know Cliff has his hand up. Is there a database of lookup for any companies we can verify, and also maybe some pre-pending suits on any of these companies?
Yes. So the fastest and easiest way that nobody does is Google. If you Google the name of the company and the name of the person, typically you'll get the case law up first. Especially if they have something ongoing right now. But a good scam artist is going to create a new company. So you have to make sure that you're looking for their name, looking for their aliases. The other thing is SEC does have a bad actors list of people who are not allowed to raise capital anymore. There's also, you're also going to want, if a person tells you they have $1 billion under management, you want to go and look them up on FINRA. You want to go and look them up in the SEC. You want to see what they had, what their offerings were previously, and if they are in compliance. Because anybody with more than $100 million under management has to be registered with the SEC. Under that, you're in a little bit more of a gray area where you may not be able to find their previous raises.
That's great information. Thank you. Cliff,
the other thing that I could say about that is, although the SEC has a minimum for their full registration of a management company, the state's threshold is much lower. So like in the state of Florida, the threshold is 25 million. So you'll be able to, if they say they're a company and they are located in the state of Florida, you can look their company up on Sunbiz, find out all about it, and then you can go to the Department of Financial Regulations and look up their actual raise. But every state has that.
Thank you very much.
You're
Cliff,
welcome.
last question.
So if I've got an established private placement memorandum and the minimum investment is outlined in that PPM as $100,000, is it at the discretion of the sponsor or the general partners in that opportunity to accept a smaller amount, or is it required that they actually have a new PPM created?
So you never have to have a new PPM created. You can always do an amendment to a PPM. But the biggest thing is, I think that most people should give themselves the option, but not the obligation. So if you think that 100,000 is a great threshold for you, put it at 100,000. You'll give, and then you say, and then the sponsor has the option to take lower amounts at its own discretion. And then you can go into those sorts of conversations with people who you may have a better relationship with, or who is vetting you and they only want to put in 50,000 or whatever the case may be. And you have that option to do it, but not the obligation. So, I mean, you don't have the obligation to take money from anybody anyways, but You always want to have the option to be flexible with your terms.
So if your initial terms aren't flexible enough, then in order to remain in compliance, there would need to be an amendment added to that private placement memorandum.
Yes.
Makes sense. Thank
Not
you.
necessarily.
What, Dylan?
I just said not necessarily. It depends on how you structure it. So like when I structure funds, here, I'll just read it directly from this. Placement of units, we're offering a sale of 300 units, aggregate totaling 15 million USD. The minimum investment is 1 unit, $50,000. However, the fund may accept subscriptions of a fewer number of units in the sole discretion of the general partner without notice.
Yes, that's what I was saying.
Yeah.
So if you don't put that language, you do have to do a amendment. But the reason you always want to give yourself the option. So
Yeah,
everything is your discretion.
Both
Great.
are very good. Thank you.
thank you. Thank you, Levon, very much. This is enlightening, informative. I've got lots of notes, and I am so grateful that you came, and thank you very much. I hope you'll consider coming back and speaking with us again.
Thank you so much for having me. It was a pleasure to meet you guys in Florida. Hope to see you again. And I look forward to learning more about being a nest egg builder.
Great, thank you.